Hey dividend investors, welcome back to the channel. Today, we are looking at a stock that is arguably the most utility-like of all utilities in Singapore. It isn't a flashy REIT with malls on Orchard Road. It isn't a bank earning record interest margins. And it certainly isn't a tech stock promising AI-driven growth. But if you live in Singapore, you use its infrastructure every single minute of every single day, likely without even thinking about it. I'm talking, of course, about NetLink NBN Trust. For years, NetLink has been the quintessential sleep well at night stock for income investors in Singapore. It pays a reliable dividend, it holds a natural monopoly on the nation's fibre network, and its business model is practically immune to economic recessions. After all, nobody cancels their internet subscription just because GDP growth slows down. In the hierarchy of needs for a modern Singaporean, I'd argue that Wi-Fi sits right next to water and electricity. But recently, the narrative has shifted slightly. After hovering in a tight range for what felt like an eternity, the share price has crept up over the past year. At the same time, we've seen headlines about dropping profits, rising costs, and a yield that has compressed to around the 5.5% mark. So, the questions on many investors' minds are valid. Is the dividend still safe? Why are earnings dropping while dividends remain high? And perhaps most importantly, does it still make sense to add this boring giant to your portfolio today, or has the ship already sailed? In this deep dive, we are going to peel back the layers of NetLink NBN Trust. We'll look at its latest financial health, decode the confusing gap between its EPS and its DPU, stress test its cash flows, and find out exactly what management is saying about their future spending. As always, a reminder that this video is for informational purposes only and not financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. I own some of the shares discussed, but what works for me might not work for you. Alright, let's jump right in. The business model. The toll road of the internet. Before we get into the numbers, we need to understand exactly what NetLink does, because its structure is unique in the Singapore market. NetLink is the owner and operator of the passive fibre network infrastructure in Singapore. Think of them as the landlord of the internet pipes that run underground, through the ducts, and into your home's termination point. When you sign up for a broadband plan with Singtel, StarHub, M1, or MyRepublic, those companies are the retail service providers or RSPs. They sell you the service, manage the billing, and compete for your loyalty. But to get that internet signal from their servers to your router, they have to rent the physical fiber connection from NetLink. NetLink's business is split into two main buckets: regulated asset base or RAB and non-RAB revenue. The regulated asset base is the core engine, contributing approximately 85% of total revenue. This is the strictly regulated part of the business where prices are reviewed every 5 years by the Infocomm Media Development Authority, or MIDA. The largest chunk of this comes from residential connections, which make up about 60% to 61% of total revenue. This is the bread and butter. Every time a home is connected to fiber, NetLink earns a recurring monthly fee. Following the latest review, this fee is fixed at $13.50 per month per connection. It is steady, predictable, and remarkably resilient. Next within the RAB segment are non-residential connections, which serve offices, schools, malls, and data centers. This contributes around 8% of revenue. Interestingly, the pricing power here is stronger, with a regulated rate of $55 per month. Finally, we have the NBAP, or the non-building access points, connections. These are the smart city nodes, connections for infrastructure like traffic lights, sensors, bus stops, and increasingly outdoor 5G base stations. This segment currently adds another 4 to 5% to the top line, but it is the one to watch for future growth. The remaining 15% of revenue comes from the non-RAB segment. This includes less regulated income streams like installation charges, ancillary projects, helping the government or telcos lay specific cable routes, and leasing out space in their central offices. While smaller, this segment allows NetLink to act a bit more like a commercial entity, competing for projects to diversify its income. In short, when you buy NetLink, you aren't buying a tech growth stock. You are buying a toll road where the traffic is data. Whether you are watching Netflix, sending an email, or scrolling through TikTok, NetLink collects a regulated toll for that connection every single month. The financial health check: stagnation or stability. Now, let's look at the performance. If you just glance at the headlines from the latest results, you might be a little worried. In the latest 9M FY 2026 results, covering the period from April to December 2025, NetLink reported an 11.8% drop in profit after tax, falling to $65.4 million. For a dividend investor, a double-digit drop in profit usually sets off alarm bells. It sounds like the business is shrinking. But NetLink is a classic case where profit after tax tells you very little about the actual health of the dividend or the business stability. Let's look at the trend over the last 3 years to get the full picture. In FY 2024, revenue was $411.3 million. In FY 2025, it dipped slightly to 407.0 million Singapore dollars. And in the first 9 months of FY 2026, revenue actually ticked up by 1.6% to 313 million Singapore dollars. So, the top line, the actual money coming in from customers, is stable. It's not shooting the lights out, but it's certainly not collapsing. It is exactly what you expect from a utility monopoly. The drop in profit is driven largely by two things: depreciation and finance costs. Because NetLink owns billions of dollars worth of cables, ducts, and central offices, they have a massive depreciation bill every year. In 9M FY 2026, depreciation and amortization rose by 6% to nearly $139 million. This increase was largely due to the completion of their new Seletar central office. When a new asset like that comes online, depreciation kicks in immediately, dragging down accounting profit. But, and this is the crucial part, depreciation is a non-cash expense. NetLink doesn't write a check for depreciation. The cash stays in the bank. This brings us to the most common question I get about NetLink, and the source of much confusion for newer investors. Addressing investor concern number 1. The EPS versus DPU mystery. Investors often look at NetLink's earnings per share or unit, or EPS, compare it to the distribution per unit, DPU, and they get a shock. For the first half of FY 2026, the DPU was 2.71 cents. But the reported EPS was only 1.11 cents. If you are used to analyzing normal companies like banks or developers, this looks like a disaster. A payout ratio of over 240%? Is the company paying out money it doesn't have? Is this a Ponzi scheme? The answer is a definitive no. This discrepancy is an accounting feature, not a bug. NetLink is a business trust, and its ability to pay dividends is based on distributable cash flow, not accounting profit. Remember that huge $139 million depreciation charge I mentioned earlier? That drags down the accounting profit and EPS, but it doesn't take a single cent out of the bank account. To see the truth of the dividend sustainability, you have to ignore EPS and look at operating cash flow per unit. If we look at the estimated operating cash flow for FY 2026, it is running at about 7.37 cents per unit. This comfortably covers the expected annual DPU of roughly 5.42 cents. So, the payout is sustainable because the actual cash coming in from operations is significantly higher than the cash going out as dividends. The dividend is backed by real money collected from Singtel and StarHub, not by debt or accounting magic. Before moving on to the next top investor concern, if you've found this deep dive useful so far, the best way to support this uncle is to give this video a like and subscribe if you haven't. Your support and thoughtful comments are what keep this uncle motivated to continue sharing my personal research and portfolio reflections. Addressing investor concern number 2. But, is the buffer shrinking? However, while the dividend is covered, we cannot ignore the second, more valid concern. The trend of that coverage is tightening. This is where the boring utility business starts to show some cracks, and where we need to be realistic about growth. If we look back at FY 2024, NetLink was generating a massive 7.85 cents in operating cash flow per unit. That gave them a huge buffer above the dividend, almost 2.5 cents of excess cash per share. In FY 2025, that dropped to 6.64 cents. And now, for FY 2026, we are hovering around 7.37 cents per unit annualized from the 9 months results. The cash engine is still working, but it's not running as hot as it used to. Why is the cash flow buffer shrinking? It comes down to 3 specific cost pressures that are nibbling away at the margins. 1. Property tax. This has been a significant headwind recently. The new Seletar central office is a high-value asset, And with higher property values across Singapore, the tax bill for their network infrastructure has risen. IT and maintenance costs. Keeping a nationwide network secure and operational isn't getting cheaper. Cybersecurity, maintenance of aging ducts, and labor costs have all crept up. Finance costs. With interest rates staying higher for longer, NetLink's interest expense has increased, further reducing the net cash available. So, is there relief in sight? This is where the capital expenditure, or capex, story becomes critical. For the past 2 years, NetLink has been in a build phase. They spent approximately $110 million constructing the new Seletar Central Office. This was a necessary infrastructure project to serve the growing population in the north, Woodlands, Yishun, Sembawang, and to provide redundancy for the entire national network. But the good news is, this heavy lifting is done. The Seletar facility is now operational. Management has indicated in recent briefings that capex requirements are expected to moderate going forward. With the Seletar facility finished, the immediate future capex will likely focus on business-as-usual maintenance and smaller growth projects, like connecting new BTO estates, rather than massive new infrastructure builds. Why does this matter for your dividend? The math is simple. Operating cash flow minus capex equals free cash flow. Even though operating costs, like property tax, are up, the reduction in capital spending acts as a counterbalance. If NetLink spends $20 million less on construction next year, that is $20 million more that stays in the distributable pot. This pivot from building to maintaining is the key reason why the dividend can remain stable even as costs rise. The heavy spending years are behind them for now. Key risks. What could break the thesis? NetLink is defensive, but it is not risk-free. If we are going to hold this for the long term, potentially for decades, we need to know what could go wrong. The interest rate ceiling. NetLink is what we call a bond proxy. Its share price moves inversely to interest rates. When risk-free rates, like the Singapore Savings Bond or T-bills, are high, a 5.5% yield from NetLink looks less attractive. Why take equity risk for 5.5% when the government gives you 3.5% for free? Furthermore, NetLink carries debt. However, I want to highlight a major improvement here. In their latest update, NetLink revealed that they have hedged 100% of their debt to fixed rates, up from around 70% previously. They also extended their weighted average debt maturity to 3.7 years. This is excellent risk management. It means they are shielded from interest rate volatility for the next few years. But eventually, debt matures. If they have to refinance in a high-rate environment in 2028 or 2029, that interest expense will jump, eating directly into the cash available for dividends. The regulatory cap, the Goldilocks problem. This is the double-edged sword of a monopoly. You have no competition, but you also have no pricing power. NetLink cannot simply raise prices to combat inflation. Their prices are fixed by the MDA for 5-year blocks. The last review, completed in late 2023 and effective April 2024, was a mixed bag. Residential prices were cut from $13.80 to $13.50. NBAP prices were cut from $73.80 to $70.50. Non-residential prices were held flat at $55. This means for the next few years, until 2029 when the next review will be, NetLink relies purely on volume growth, more connections, rather than price growth. And let's be honest, Singapore's housing market is mature. Volume growth is slow, tracking simply with new HDB and condo completions. We are looking at low single-digit growth at best. The good enough substitute risk. For years, fibre had no rival. If you wanted fast internet, you needed NetLink. But technology moves fast. Today, 5G is fast enough for many casual users. While it is highly unlikely that Singaporeans, who live in high-density concrete jungles and consume massive amounts of data, will switch to mobile broadband en masse, the risk is at the margins. If 5% of households, perhaps single professionals or expats, decide 5G home broadband is enough, I don't need a fibre point, that is a direct hit to NetLink's recurring revenue. Currently, residential connections are flat at about 1.5 million. We need to watch this number like a hawk. If it starts trending down, the thesis breaks. The dividend uncle's take. So, where do I stand on NetLink NBN Trust today? NetLink is the definition of a portfolio stabilizer. It doesn't give you a heart attack during market crashes, but it won't make you rich overnight during a bull run. It is the goalkeeper of your football team. You don't buy it to score goals, you buy it to stop you from losing. At the current price range of 95 cents, the stock is trading at a yield of roughly 5.5%. Here is my personal take for this stock. I view NetLink essentially as a corporate bond with an equity kicker. The equity kicker is the potential for slight dividend growth from new housing estates and the Smart Nation 2.0 initiative. As Singapore installs more smart sensors, traffic cameras, and outdoor digital infrastructure, i.e. the NBN segment, NetLink gets a small cut of that growth. The bull case. I think if interest rates are cut aggressively in late 2026 or 2027, NetLink will likely re-rate upwards. In a world where fixed deposits drop back to 2%, a 5.5% stable yield becomes incredibly attractive. The share price would likely drift up to compress the yield. In that scenario, you get the dividend plus capital appreciation. The bear case. On the other hand, if rates stay higher for longer, the price will likely stay stuck or drift lower as investors prefer risk-free T-bills. The dividend might stay flat or grow very slowly, barely beating inflation. It becomes a dead money stock that just pays coupons. So what I'm personally doing? Although I still like NetLink, but I am price sensitive. At 95 cents and above, the yield cushion starts to look a bit thin compared to a risk-free 6-month T-bill or a high-quality fixed deposit. I am personally not aggressively adding at these levels. The risk premium just isn't quite juicy enough for me. However, I am happy to hold my existing position. It serves a specific role in my portfolio. When my REITs are volatile and my growth stocks are bleeding red, NetLink just quietly deposits cash into my account every 6 months. It lowers the overall beta, or volatility, of my portfolio. If the market corrects and NetLink drops back towards the 90 cents level, pushing the yield towards 6.0%, that is where I would look to accumulate more. At 6%, I think it would be a fairer return for a monopoly asset. For now, I will be keeping my holdings of NetLink for income stability. It's not exciting, and the recent drop in accounting profit is just noise that hides a stable cash flow machine. But don't chase it thinking it's a growth stock. Treat it for what it is, the utility of utilities. What about you? Do you own NetLink for the stability, or have you swapped it out for higher yielding REITs or banks? Do you think the 5G threat is real, or just overblown? Let me know in the comments below. I read every single one. If you found this deep dive helpful, please give the video a like, it really helps the channel grow. And if you haven't subscribed yet, hit that button so you don't miss our next deep dive into the Singapore market. Thanks for watching, and until next time, happy investing.